9 more dividend ETFs with absolutely zero NAV erosion. And one of them is going to pay you every single week. So if you're interested in high yields, in good solid dividends with zero NAV erosion, you are in the right place. If you like dividend ETFs, weekly payers, monthly payers, don't forget to like the video and to subscribe so you never miss out on future updates. This is a part 2 because you guys loved the first video so much. So we're going to jump right into it after the intro. Starting off, we have a very quick idea of NAV erosion, and it's very important. If you don't know what NAV erosion is, it basically comes down to your initial investment decaying or eroding over time. Different fund managers don't like the term NAV erosion or NAV decay because it does all depend on the option strategies being implemented and their overall success with those options. But we do have to talk about it because if you invested whoever knows how much money into IWMI and it dropped 45.6%, it'd be a bummer. Your initial investment, all the money you put in, you'd lose almost half of it. But overall, you would be positive total return during this time span of 2023 to 2024. You'd actually be positive by 14.93% with dividends reinvested. But some people don't want to reinvest dividends, so it all depends on your strategy. But NAV erosion is important, whether or not you agree with the term or you think it's made up or it's just people not understanding what's actually happening with the fund. You have to understand what is going on with the funds and if it matches your investment style or strategy. So I just want to touch on that. Let's jump into these picks. Now we can see here IWMI. I chose this one. I left it out of the original list because it's a little bit of an underperformer just because the Russell 2000 hasn't been doing as well, but it's still very, very solid. We have a 14.45% dividend yield or distribution rate and an expense ratio of 0.68%. Still a little bit high of an expense ratio, but the returns have been pretty solid, even if they are a little bit lackluster behind, QQQI. But I do want to also mention, if you're looking at this and going, well, this has NAV erosion. Look, the price has gone down. We have to compare it to the Russell 2000, which is RUT. And here we can see, although it has fallen with the Russell, it just takes more time to bounce back. And it's not including the dividends. So it's not NAV erosion. And I get this comment a lot that some of these funds have crazy NAV erosion. If you see the underlying falling in price, the options contracts are going to be harder to make money on, depending on how the strategist is working it. But you're not going to have one of these income ETFs still going up in the green every single week if the underlying is falling. It's just how it works, whether it's synthetic calls, they hold a position in the underlying investments, yada, 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 all of which are different tactics different companies use. It's not going to outperform it, especially in a red market. Sometimes they do outperform it in certain green markets or certain markets, but it's not NAV erosion just to see the overall NAV fall with the underlying falling. Now, it's probably not going to recover as well, especially even with the dividends, but it should be relatively close. But IWMY is kind of a sleeper pick in my opinion. It's got a high yield. The total return isn't bad, but we'll see how it stacks up to our other choices. I was reamed in the comments and on X or Twitter because I didn't include JEPI. There's a reason I didn't. I put JEPQ in, which I believe is the better fund. I just do. And we can see with JEPI, the dividend yield of 8.46% is a little bit below what I would like to have. It just is. I was really not impressed with JEPI's overall performance as we're going to take a look. One thing that is a bonus about this fund is the expense ratio is only 0.35%, about half a lot of the others. But I'm okay with the higher expense ratio if I get more out of it. If I get a better total return, if I'm getting better dividends and pretty solid NAV stability or even NAV increase on my initial investment, like I've seen with a lot of the NEOS funds. But overall, I think JEPI was very, very new, very, very interesting when it first launched. It's still one of the largest income ETFs. And in comparison to some of the others, originally the global X ETFs, RYLD, QYLD, and XYLD, JEPI was a better performer. So it really took on a bunch of eyes at one point. Everyone was investing into it. I believe during one point, it was the 1 year. I can't remember what year it was. It was post-pandemic. But it actually was the most purchased ETF that year, right behind SCHG. And I should say income ETF. I don't know if it was every ETF, but I think it was income ETF. So still a very impressive thing, but all in all, it's just a little bit slow for me these days. This is a really, really interesting pick that not a lot of people talk about. And if you're interested in ever owning real estate, this one might be the choice for you. We have IYRI, the NEOS Real Estate High Income ETF. There's a lot of things, and I've been going back and forth with this myself because I would like to get into the real estate game, but I don't want to be constantly working and managing and getting new tenants and kicking out tenants and evictions and yada, yada, yada. There's a lot of legal issues as well. There's a lot of expenses where you have to have legal backing. You have to understand what's going on. Sometimes you'll have property management, and maybe I don't want to do that. Maybe I just want to throw it all into a REIT or IYRI and get a little bit of exposure to overall real estate with a nice yield, which is 11.13%. The expense ratio of 0.68% is still pretty high though. Now I will say I love the NEOS funds, but their expense ratios, they're up there. They really are compared to a lot of these other ones. But all in all, I think IYRI is a really good option. Also, say that 5 times fast. I'm sorry. That ticker, who chose that? That is not a good one, in my opinion. As someone that makes content on these, having to say these ticker names over and over and over again, it's hard. But if you are looking for some real estate exposure, and in the meantime, you don't know if you want to actually buy real estate and hold it, you just want to have someone kind of do everything for you and you'll pay a fee, there you go, IYRI. And I think it's a really interesting way of doing it as an ETF versus some normal REITs that are usually a little bit lower yielding. You have a little bit more risk with it, but we all know that NEOS has been absolutely cooking, and I love to see their overall returns, and I think they're going to keep putting out more and more of these funds. And there's a lot that people don't talk about, one of which is coming up later on in this video, and I guarantee you haven't heard of it, because I had barely heard of it, even through the grapevine. So I hope you enjoy. Let's jump into our next ETF. Now we have IQQQ, the ProShares NASDAQ 100 High Income ETF. And I like IQQQ. I initially did a challenge where I bought 10 of these higher yielders. I had IQQQ, I had ISPY, I had SPY, I had QQQI. I had all of them and I was comparing them. And it turns out it was very boring to do it. I'm not going to lie to you. I didn't actually have to buy all of them. I don't know why I did, but I still did like doing it, but the videos did not do well. So I scrapped the idea. Maybe I should bring it back one day, but I do just like overall tracking them. I don't have to necessarily own all of them to track them, but I do think it helps. So it's $42. The yield is pretty solid at 13.33%, and it's got a lower expense ratio, 0.55%. I like that. I like that they're not charging an arm and a leg for this, and the overall return is not bad by any means. We're going to look at it, though. I don't know how it stacks up to QQQI, to some of our other NASDAQ high income ETFs. I will say, I haven't said this yet, I think the NASDAQ, because it's so tech heavy, and the NASDAQ 100 holding 100 holdings, that sounds dumb, versus, the S&P 500 with their 500 holdings, a little bit higher in volatility, a little bit higher risk, but we've seen some crazy performances from a lot of the NASDAQ funds, and I'm wondering if the S&P 500 would ever keep up. I was kind of surprised, too, that the Russell 2000 income ETFs underperformed, because you'd expect higher premiums because they're higher risk, it's lower cap stocks in the Russell, but all in all, QQQ, the NASDAQ, has been outperforming everything. So expense ratio is a little bit lower with the ProShares. I really like that. We have another ProShares one coming up in just a minute, but we have one to look at first. This ticker is absolute gold. We have IAUI, and I mean literally, it's gold. We have NEOS Gold High Income ETF. And I was interested in this one early on. If you didn't know, gold has been going absolutely ballistic. And if you're afraid of inflation, gold is your friend. I don't own any physical gold, so don't try and rob my house. But I think it would be cool eventually to have some, whether or not physical or in one way or another, you hold gold for when inflation's crazy and when gold value just continues to go up, which it seems like it's going to. Now, and I'm not an expert in gemology. That's not it. Geology? No, it's got to be gemology, something like that. I don't know if we're going to have an instance like with diamond where they synthetically can create it. I know that gold is used a lot in tech and all sorts of things now, but are we going to have something like that where we're going to drop the price? Because I'm not buying real diamonds that are being mined in a really unfortunate way by someone that's not getting paid enough when I can buy some scientist in a white lab coat to build one, right? Just me personally. Maybe some people like the real diamonds, but I don't know. That's a bit of a tangent, but I overall think that the gold high income ETF is very solid if you want some exposure to something different than the main indices. And while it does pay monthly a very solid 12.36%, the expense ratio is 0.78%. I'm not sure why it's higher than a lot of the other NEOS funds, including the real estate fund. That's a good question for their CEO or someone on their team. Kind of interesting though. Not quite sure why that is. But now we have another fund to talk about, one that I've only talked about one other time on the channel that I think you guys are really going to like if you love Bitcoin. Be forewarned, this one has not been out for very long. It's an Amplify fund, which I'll have to do more videos on their funds. No one seems to really talk about them as much. Started trading in April, so very new. Very, very new. Probably even too new to say there's no NAV erosion, but as long as they pay out relatively consistently and Bitcoin does semi-well, I'm happy with it. And I think Bitcoin in the long run is going to do really, really well. But remember, if we saw a crazy tanking of Bitcoin back down to 80K, 60K, these would take a crazy hit. And it wouldn't be NAV erosion. They're not losing money on the options. They're just losing money because the market is down. But BITY has a 24.65% dividend yield. Boom, amazing. It also has an expense ratio of 0.65%, which is a little bit lower than a lot of the others, but still pretty high. Now, I like Amplify. They have a lot of good options. They have a couple of Bitcoin funds, actually. If you didn't know, I did a full video on all the income Bitcoin funds. There's like 11 of them, and oh my goodness, it's hard to find all of them. There's so many, and I probably still missed 5 or 10. But I'm really impressed with this one. It's been doing really well. It's been holding up against BTCI, even outperforming it in a couple of instances. And so I think it's pretty solid. They seem to be kind of not necessarily copying Neos, but almost improving on some of the aspects of it, but it is still too new to tell. So from what we've seen, it's been doing well, but you never really know. All depends. Maybe BTCI does better in a down market, maybe Amplify better in a really green market for Bitcoin. It all depends, but we want to know that when we do see those markets shifting. I do also want to say, I have an interview. I'm not even calling it an interview. It's just going to be like a yap session. Yapping, for those that don't know internet lingo, means we're just talking too much. I'm going to be meeting with some YieldMax strategists, a lot of people from the YieldMax team. I've been in communication with them. We're doing a sit down. We're going to talk about it. We're going to film it, a virtual sit down, I should say. So if you have questions that you want me to ask the YieldMax team, let me know. Put them in the comments. I'm going to compile a bunch of questions. You don't have to pay me for questions. I'd love to ask all the good questions, and you guys are really good at coming up with great questions. If you want to know about ULTY, if you want to know about Coney, if you want to know about the future of the income ETFs, the weeklies, the monthlies, anything you want to know, put it in the comments, and I'll try and bring it into that conversation. I'm really excited. It's going to be really cool. I met them in New York when they invited me to the YieldMax event, and I was on the big screen in Times Square, which is so weird. So weird for me to be up there, right? Some random guy from California, but either way, it was still very, very fun. So put your questions down in the comments, and I'm doing that on Monday. So you got to make it quick. If it's past Monday when you're watching this, you might have missed the boat. Anyways, BITY, very impressed with it. I overall do think Bitcoin is going to continue going upward. I don't know. We may see a crazy pullback. We may see who knows what. I have a Bitcoin friend that tells me all the info, and he's usually right. So he's saying he's not sure what's going to happen next. He's watching all the smaller coins and yada, 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 but very interested in seeing what happens. And if Bitcoin continues on this trend, BITY is something I will be buying. ISPY is similar to SPY, but it is by ProShares. We have an 11.81% yield and an expense ratio of 0.55%. So what we have seen, I'm not sure total performance wise, but the yields are usually a little bit lower than Neos, whereas the expense ratios are also a little bit lower. So it depends on what you're looking for. You know, putting them head to head, maybe I'll have to do a video on that comparing, but I do think ProShares is pretty solid. And if you find certain ones that you like better based off the companies, you can always side with that. I always say diversify. I don't have all of my money into YieldMax or Roundhill or Neos or ProShares. I have it split up all over the place, not only by the underlying asset, but by the issuer, just as a security thing for me. Maybe it's just me. You guys don't have to do that. Not financial advice. But overall, I've been impressed with ISPY. It pays monthly, consistent, high yield, lower expense ratio than a lot of the others in the same space, so you can't really complain. Now for our weekly pair, and this might be too early to say, but MAGY, I've been very, very impressed with it. And there's a few reasons why. First of all, it compares to YieldMax's YMAG, but there is a very distinct difference. YMAG is using all of the underlying funds from YieldMax on the Magnificent Seven. So you have all the separate ones. You have the one on Facebook, on Microsoft, on Tesla, on NVIDIA, all compiled into one. MAGY is using their MAGS ETF. So if you didn't know, Roundhill also has growth ETFs, and MAGS holds all of the Magnificent Seven ETFs. And what it means is if you have a really bad month for just one of the 7 holdings, and someone correct me if I'm wrong on this, but you would see less of a drop with MAGY because they're not writing individual options on the underlying. So it's just as diversified, but in a better way. Whereas if you saw, let's say Nvidia tanked and we saw NVDY payout really low and the price fell like crazy. Well, the options and the volatility on that one are going to really pull down YMAG. Whereas if it did that in the MAG ETF, you have the other 6 already there to fix it. And in the same way, it's not going to be, I don't know if it'd be a crazy difference, but with YMAG, you would still also have the Tesla, the Microsoft, Apple, all the other funds to kind of try and hold that one up. But they're writing the options differently because when they're writing the options, it's on single stocks. This one, it's on a single ETF that holds single stocks, but it holds 7 of them. If that makes sense, I hope it makes sense. If it doesn't, let me know in the comments and I'll try and clarify. But MAGY has been doing really well. And it's also still underperformed MAGs, the ETF, but that's what it's supposed to do. So we haven't seen NAV erosion, but I don't think we will see NAV erosion with MAGY because the Magnificent 7 stocks are going to, in my opinion, keep going up. If we saw a crazy tanking in the market and crazy downtrend, then yes, you'll see the price go down. But they're not going to be paying out so substantially that the underlyings can't keep up because we're kind of factoring in the growth with the underlyings as well to keep the overall price of MAGY solid. And the dividend is high. It's 35.66%. And so is the expense ratio. Roundhill. Come on. Come on, friends. 1.28%. Wow. One of the highest that I've seen, but the performance has been pretty amazing. So now we're going to stack all of these up head to head in a drip calculator and see which one comes out on top. Starting off, we have IWMI versus JEPI, the first 2 on the list. And I will say IWMI comes out on top, but JEPI did pretty well in comparison. During this time frame, we can see we have IWMI returning 11.4% versus JEPI's 10.16% with dividends reinvested. Dividends not reinvested, they're still relatively close. I am impressed. I didn't think JEPI would do so well. And if you note, during the down market a couple of months ago, JEPI held up a lot better than IWMI. It tanked. Now it rebounded and barely outperformed, but it dropped. So during a bad market, it's definitely a higher risk fund, and the Russell does get beaten down like crazy, but during a good market, it also rebounds better. So it all depends on what you're looking for, but JEPI is eliminated. Now we'll go into our next pick. IWMI versus IYRI, and it's not even close. Now, I will say IYRI started trading the January 15th of 2025. So what the drip calculator does is it pulls the same time frame for IWMI. So it's fair. You can't have 2 years of trading history for one and 1 year for the other and do a fair comparison. But real estate was kicking booty. 11.8% annualized gain, total return of 7.02% since the beginning of the year versus 3% for IWMI. So IYRI is the winner, takes the first place spot, and it also held up a lot better in the bad market. Something to think about. I know not a lot of people are thrilled with real estate or they're not interested, yada, 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 but it could be a cool way of making some income. This really blows me away because IYRI also outperformed IQQQ by a decent amount. I mean, almost a percentage, 0.8. So we can see 7.02% total return for IYRI and 6.26% for IQQQ. Now remember, ProShares or IQQQ and ISPY have a lower expense ratio by 0.1%, I believe, which is a factor to think about. But still, I'm very impressed with IYRI so far, and I think this fund does need more attention. It still outcompetes IAUI. It's not super close. Since the inception of IAUI 2 months ago, IYRI is up 3.20%. IAUI only up 1.03%. Now, we haven't seen IAUI perform for that long. It has only been a number of weeks, so we can't really expect it to perform any certain way. We just have to see it trade for longer, and it has to get a little more of its name out there. People need to start recognizing it. But still, IYRI keeps holding on. It is still in the first place position, but is that going to change? This is crazy. We have BITY outperforming IYRI by 14%. Since the inception of BITY, which was May of this year, it's up 18.3%. That's an annual gain of 60%. So 18% versus 4% for IYRI. And we know that the Bitcoin funds have been going nuts. People don't seem to like them as much. I don't own BITY or BTCI yet. I keep waiting, but here's the thing. I know that the minute I buy it, Bitcoin's going to crash because I have this crazy ability to predict the market perfectly, but in the worst way imaginable, where when I buy it, we tank. So some people trade, like they'll sell their trades. I should sell the inverse of my trades, because if I buy something, it's going down. I'm like the Jim Cramer of YouTube content creators. It's a gift, guys. It's a gift. And also a curse. But all in all, BITY, absolutely amazing. It takes our first place spot. If you didn't watch the last video, I'll link it at the end of this one. But that one had, spoiler alert, BTCI taking the throne, and it was not close at all. So do we have any other funds that can keep up with these? Let's find out. Although it didn't beat BITY, ISPY was cooking. Since May, it is somehow up 16.2%. Doing really, really well. And BITY is up that 18.3%. So 2% difference, 2.1% technically. You know, I'm going to get comments. No, it's not 2%. But close enough. I love you guys in the comments, by the way. I'm just making fun of myself for the most part. But we can also, it's just wild. I'm really surprised ISPY has done that well. Maybe I should look into this fund a little more. This is why I like doing these videos. I find things I'm like, wow, that's actually doing amazing. Maybe I should own it. There we go. And I hope that you guys see this just as an opportunity to see how things are performing. But BITY does still come out on top, 18% since the inception, but ISPY, 16.2 since the inception of BITY. So pretty impressed by that one. And it has a lower expense ratio. It even outperforms MAGY, but I also believe that ProShares ISPY would have been in second. I think it even would have outperformed IYRI, which is very, very impressive. But BITY, that we have that 18.3% with, again, dividends on, dividend reinvestment turned on, and MAGY's 12.43%. This one, they're both relatively new, so we don't want to judge anything based off of just these last couple of months of trading. I always like to wait at least a year before I buy into an ETF, unless it's a growth one that I absolutely love. But I'm very, very impressed by a lot of the ones on this list. And MAGY being one of the top performers and paying weekly is going to catch some eyes for sure, even though it does have that higher expense ratio. But I hope you guys did enjoy this video. If you did, check out part 1. That's going to be popping up on your screen right now. And don't forget to like and subscribe so you don't miss out on future free content. You guys are absolutely amazing. Check out my free cheat sheet down below for the weekly payers, and I hope to see you in the next video.